Hello and welcome to this week's Market Matters weekly video update. My name's James Gerrish on Thursday, the 19th of May. And today I'm joined, or I'd like to introduce you to a new member of the Market Matters team, our research lead, Sean Hickman. Sean's joining us to coordinate the Market Matters research function. So we've got some great developments coming up in terms of Market Matters, the platform we're about to roll out. But Sean, welcome aboard.
Absolute pleasure. Thanks, James. Really exciting.
I guess as the Market Matters business evolves, we're building out the team. We need to create a wider team with a greater depth of knowledge and experience. And I'm really excited to bring Sean on with such a big and diverse range of experience over the last 30 years. You've been in many varied market roles, a lot of trading on your own personal accounts, and your depth of experience is going to be a great resource to our Market Matters subscribers.
Oh, it's such an exciting time. Everyone's scared about the market, but we should just look at what the share market does to create wealth in the bigger picture. The last 2 years, everyone thought the market was going through the roof, but we had plenty of stocks that halved in those 2 years, plenty of stocks that went up 300, 400, 500%. So the next 2 years, even if we do have a wobbly market, there's going to be so many opportunities out there for the informed people that can stand back and have a look at both the macro picture and the fundamentals of the stock. So it's such an exciting time.
I think that's a really exciting thing, and one of the reasons why we're building the depth of knowledge in the team around macro analysis, around timing in the markets. I think that's going to be, if you look over the last 5 or so years, we've been in a pretty supportive market. It's been a little bit choppy at times, but it's been supportive. We've been writing recently around our active approach to the markets, our belief that we need to be more active going forward, given the economic backdrop that we're now operating in. So I'm just going to start with getting some of your bigger picture takes from an index point of view, and then dig into some of the commodities, currencies, interest rates, etc. Because you really do have a real depth of experience from a macro standpoint. So how do you view, what's the market looking like to you at the moment from a bigger picture index perspective?
The first thing is, I'd like to go back one step slightly there, James. You mentioned about the timing, etc., of the market. What we're seeing is a situation where the market is moving. What would normally take 6 or 12 months is moving in 4 or 6 weeks. You've got to keep your finger on the pulse. We're not traders at Market Matters, we're investors. But you have to be a little bit more nimble than you would have done, say, 5 or 10 years, when the market was rewarding average companies that are still going up. That's not the case now. Money is not as cheap as it was. It's not expensive. It's not vaguely expensive over the last 10, 20, 30 years, but it's not free. Money was free, but hey, in Germany, they were giving you interest. They were paying you to borrow money. That's not the case anymore. We've all seen it with mortgage rates. So companies have to deliver more to keep ahead of cash in the bank. So people have to be smarter to really make money. And if companies don't deliver, they're going to get hurt.
We've certainly seen that in this upcoming reporting, or the recent reporting season. And I think the market's turned its focus from what it was rewarding before. I look back in the last couple of years, and a lot of these growth companies were being priced on multiples of sales. You were seeing growth companies on 10, 15 times sales. We've now transitioned back to a market that's focusing on good old-fashioned fundamentals. Earnings are becoming a lot more important. The asset base of a company is becoming a lot more important. The balance sheet is becoming a lot more important. So I guess it's a big tectonic change in trend in the market, the way investors are looking at it. The market can be very transient in how they, what they value. It can be a very fickle place. Yep. So understanding that fickle nature is a really important thing, and having a grasp on where money is flowing around the markets is really interesting. It's one of the things that you're going to be focusing on heavily for the Market Matters subscribers.
No, absolutely. And we're seeing that at the moment. The market is incredibly bearish at the moment. So I think we're probably going to bounce because the market likes to go down the path of most pain. The market was heavily overweight commodities only 6 weeks ago, and most commodity stocks in Australia have fallen 25, 30%. So knowing where the crowded money is important. Doesn't mean you're going to make money by going against it, but you should be aware of it. You should be aware that if I'm going to buy a buy now, pay later stock, how many people are on this in terms of hopeful future earnings as opposed to today? As you said, people are rewarding today value, dividends, assets, etc. Old-fashioned things that worked 10 years ago. Growth at any price is gone. It's history until further notice.
I think that's when I stand back and look at the Market Matters business, we've obviously evolved over the last 5 to 7 years. We've recently launched a new website. As I said before, we're about to launch Market Matters 3.0, which is what we're internally framing it as, which is going to bring market data into the site. It's going to bring a lot more fundamental information into the site and build out the depth of our knowledge. So I think that's one of the keys that we're working on now and into the future at Market Matters, identifying areas that we need to build out in terms of the website and in terms of the experience that we're bringing on board. So me personally, I'm very excited to have Sean on board to go to underpin the next phase of Market Matters and how we're going to communicate and detail our views to subscribers. I want to now, you touched on commodities, you've touched on indices. So what about in the currencies and interest rate space? The interest rates arguably have been the most influential component over the last 6 months. Simply some huge moves in the bond markets. I know you've had a lot of history in terms of bonds, etc., operating in the bond space. What have you? It's been carnage out there in bond land.
Oh, a lot of people have lost a lot of money because they've underestimated how far the market could go. I paid my rent 30, 40 years ago by trading the 3-year bonds day in, day out. And I know some of the people doing the same thing at the moment would have lost a lot of money because they would have thought it can't go that far. But the elastic band has kept on stretching and kept on stretching. So we've got a seismic change. We've gone from being a 30, 40-year downtrend in interest rates to a technical break on the uptrend if you look at, say, the US 30-year bonds. So my gut feel is we've probably gone a little bit too far, too fast. But hey, interest rates were negative. They're not going to be negative. We could easily go another 2% on the actual bond market, a lot higher but in terms of the official rate. And we're still back to average levels of the last 10, 20 years. So I think people have to understand that it's time for a rest, but don't underestimate what they can still do again.
Is that a key to the market? There was a quote that I was on an earnings call recently, and one of the guys on the call made the quote that it's easy to be precisely wrong in the market, but it's the important thing is to be generally right. So we talk about we look at short-term trends in the market, and we focus on the day to day. It seems to me that getting the bigger picture trends is going to be key moving forward. You talked about interest rates declining for 30, 40 years. We're now likely to go into a scenario where interest rates are going up. These bigger picture trends are things we've got to be really focused on.
Totally. And I think one of the ways I like to say, and I know you've used that phrase a few times in recent reports, I think people should invest to sleep. In other words, if you're holding a company that's, let's say CBA to be boring, that's going up, that's making good profits year in, year out and paying you a good dividend, if it drops by 5 or 10% due to market noise, it shouldn't bother you, assuming you understand the company. Whereas if you've been playing around the edges and stocks aren't necessarily performing, you're going to get hurt. So I think that's very much the case. The bigger picture, the trends are what make you money. The little moves, like I mentioned, the bond market might be a bit tired and a bit stretched. They help you with a bit of trade location, but they shouldn't really dictate the structure of your portfolio.
Sean, insightful. Once again, welcome aboard. Great to have you into the Market Matters team. As I said before, we're really excited to launch a couple of, some big improvements to the Market Matters website, some depth of information on our site, depth and insight from our expanded team. So again, welcome aboard, and thanks to all our subscribers for continuing to follow our reports. We'll be back with you next week for another Market Matters video update.